I'm wondering, once we start to get this data in from the companies, we start to get their guidance, and we start to hear from the CEOs, what do you think we'll be able to glean from this commentary and from these numbers about the future?
Yeah, I think the actual reports for Q1 are somewhat of a non-event, given that 2 out of the 3 months were pretty decent months. The problem is that given that a very large percentage of companies, certainly a record percentage of companies, have simply withdrawn guidance, that suggests that they're not likely to be terribly more specific in their quarterly calls as they report first quarter, because in many cases they're not really armed with much more information than they were a few weeks ago at the point where many of them withdrew guidance. So I think probably the takeaways might be more macro in nature and help guide top-down assumptions of what's going to happen in the economy. I also think what's going to be important is what companies say about some of the programs that have been put into place. You know, who is taking loans from the various programs that are out there, who isn't, what the plans are with regard to payroll, what percentage, if they've laid people off, they consider temporary layoffs versus permanent layoffs. So I think you'll get a bit more macro color than you will specificity on what analysts are going to do with their 2Q numbers.
Yeah. We just want to bring some headlines crossing the wire. One thing we didn't mention a little bit earlier was the buying that we saw in the Treasury market today. Yields starting to trickle down on the 10-year. The yield curve also starting to flatten a little bit. We're getting China's February U.S. Treasury holdings are at a 4-month high of $1.09 trillion. Keep in mind, this is from February, so this predates the COVID-19 crisis, Scarlett.
It predates the COVID-19 crisis in the U.S., but not necessarily the COVID-19 crisis in Asia. Japan's February holdings of U.S. Treasuries also rising to a record $1.27 trillion. So Japan holding more Treasuries than China, at least officially, because Japan has $1.27 trillion worth of Treasuries as of February. So let's stay on the bonds angle here, Lizanne, because I want to ask you about the task of repositioning, rebalancing your portfolio. We saw it at the end of March, following the lows of March 23rd, when investors started to rotate out of bonds and into stocks willing to take on some more risk. What does it look like right now? Has it run its course?
Well, so a lot of that rebalancing that occurred into quarter end was somewhat systematic and automatic. It wasn't necessarily just a qualitative decision to go ahead and do that. So some of that was driven by the programs themselves. You know, whether that's reversed enough that you're going to see it in the opposite direction. You know, our message around rebalancing for our individual investors that, of course, are not necessarily doing it in a particularly systematic way, is that a lot of investors will use calendar-based parameters for rebalancing. They might do it on a quarterly basis, or if there are, turnover or tax implications, they might do it on a less frequent basis like annual. We've been saying if you have the ability to do it based on actual portfolio moves, basically let your portfolio tell you when it's time to do something by virtue of big moves in asset classes in one direction or another, that will afford you an opportunity to rebalance maybe a bit more frequently, but taking advantage of those market moves so that you're sort of always kept on the, for lack of a better word, right side of the trade by, adding into weakness and trimming into strength. So that's what we've been telling investors to do. Again, if they're not going to offset that by trouble with too much turnover and the tax implications of that, is let the volatility work in your favor to drive when it's appropriate to do rebalancing.
Yeah, that's a good point. I mean, of course, a lot of us just put on a blindfold and hope for the best. So, Lizanne, we only have a little bit more time here. When you sort of look at other asset classes outside of equities, and particularly, I'm curious of what your thoughts are on the dollar and how that's going to factor in to some of the gains or losses that we might see in equities based on what it's been doing.
Yeah, so our view is that in the medium term, there's more likely to be downward pressure than upward pressure on the dollar, given that we've effectively launched unlimited QE and pinned rates now down close to the zero level, maybe not in perpetuity forever, but for an extended period of time. But there are other forces that have propped up the dollar. We've also seen a wider range the dollar has been in, so more volatility. We would expect that to continue, where you saw record-breaking volatility in the equity market. That was followed by the same in the Treasury market. You're seeing it to some degree in the currency markets as well. But when some of that volatility settles down, we think the path of least resistance is a bit more down than it is up.